Folks, it is Tuesday, December 29th. I'm Guy Adami. I'm with my dear friend Dan Nathan at Risk Reversal on Twitter for this week's macro setup, brought to you by our presenting sponsor, Nadex, the premier U.S. exchange for binary options, call spreads, and Dan knows the last one, knockouts. And Dan, I mean, it's been an amazing year. I want to wrap a lot of stuff up and look forward to next year. But, you know, here we are on this Tuesday. Again, another new all-time high in the market. Although, as we tape this now, things are reversing. What sticks out to you? And let's talk about some of the things we're looking forward to in terms of potential catalysts for the market.
Yeah, you use the term looking forward to, and you know, one of the things I think is just really ripe across all major equity indices, the globe over here, is optimism about 2021. Obviously, a late story in 2020 was the introduction of vaccines, not just one, the Pfizer, but then we had the Moderna. Now we're waiting on the Johnny John, the AstraZeneca. So it seems like we're going to have a lot of vaccines to inoculate the globe's population. And that just seems to be the thing that is kind of buoying at least the appetite for risk as it relates to investing in equities. And so, you know, I guess the question I have to just contemplate here is, with the U.S. Equity markets literally set to close at the all-time highs without a real meaningful pullback over the last 2 months, how much of performance has that pulled forward into early 2021? And are we set for some sort of what I would say is, at the very least, a healthy correction to kind of set the stage for another leg of the rally?
No question. I mean, the answer, in my opinion, is not only have things been pulled forward, but there's going to be a dearth on the back end, because there's not going to be the demand that the market suggests. And that's not me being pessimistic. It's me just trying to read the tea leaves. So to Dan's point, so much has been pulled forward, and this is not a Fed bashing thing. We're not into it. But just keep in mind, folks, that the U.S. Federal Reserve is buying $120 billion worth of assets each month. Just put that in perspective. Obviously, you do the math, you're talking about close to, I don't know, 1.8 or so trillion dollars worth of things that they're adding to their balance sheet every year. Now you're talking about a balance sheet that at its peak was at 4 trillion when Jerome Powell was trying to whittle it down, and now is north of probably 7.3, 7.4 trillion. So much of this has been predicated on that. I bring that up because if you do get this reacceleration, the Fed's going to have to take their foot off the gas, and I think that's where the concern is going to be. It's not for January, it's not for February, but I think at sometime mid-2021, that's what we're going to be talking about every day on Fast Money and every week on the macro setup. And it should be concerning because it concerns me, and I think people are trying to look past it. The fact that the market seems to think there's going to be a straight line from here to whatever term you want to use, herd immunity or 75% of the population being vaccinated, there are no straight lines. And I think the market's in for probably a rude awakening, again, early in 2021, Dan.
Yeah, so that's probably, I guess, the biggest surprise, you know, to investors might be the fact that we're just not reaching that level of herd immunity, which would allow for, you know, economies to open to their fullest and get back to, you know, peak sort of activity, which would also indicate peak earnings, which would be 2019 earnings. And I think you're kind of catching, at least for equity investors, on two sorts of things. What sort of multiple right now are you willing to pay to get back to those 2019 earnings at some point in late 2021 or 2022? And without a meaningful correction, at least kind of shaking out some weak hands, to your point, you just can't get from point A to point B in a straight line higher. You know, let's look at the S&P 500 guy, because when we talk about valuation, you know, it's trading about 22.5 times, you know, forward earnings expectations, which is extremely high relative to its 5-year average of about 17.5 times and its 10-year average of about 15.5 times here. So any hiccups early in 2021, and investors are going to start thinking twice about what they are willing to pay for those future earnings. You know, I drew a few little lines here. We know that February high, the prior all-time high before the market crash, is a good starting point here. We look across there, it's about 3,400. And to me, you know, we're what? 10% above that right now. 15% above those early November pre-election highs. We're getting very steep above the 200-day moving average, but that 3,600, I think, is a September 2nd high, seems to be good support to the downside. That's down about 135 points or so, but then draw a line, a resistance line from that September 2nd high, and that's also become support. So every major resistance level, at least from a technical standpoint, has now become support. Where do you see a healthy correction back in the S&P 500 if it were to come early in 2021?
See, the problem is, a healthy correction would have been a lot easier 150, 200 points ago. But just when people talk about the same way they talk about coiled springs in the market, in other words, an equity or security or a commodity that has been pushed down to levels where it just takes a little bit of a the flip side of that, the opposite of that, is sort of this rubber band thing where markets expand, 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 and then the rubber band snaps back. And I think that's what we're setting up for here. The higher the S&P 500 goes, in my opinion, the worse this correction is going to be in terms of speed and in terms of where we finally land. I think you're right in terms of your levels. And if you're playing knockouts and binary options, at 3,600 level makes sense for a myriad of different reasons that we've discussed. And oh, by the way, there are some catalysts. And one of them, I think, comes in the form of this runoff election I think it's actually next week, as it turns out. I mean, that's how close this thing is. And oh, by the way, Dan, I think on that same day, President Trump just called for a rally in D.C. that I don't think people are paying enough attention to, because I think you could get some fireworks out of that. So if you're looking for a close catalyst, January 6th makes sense for a lot of different reasons. I don't think the market is pricing either of those things in, but in terms of levels, 3,600 first stop, and you look at those prior bottoms at 3,200 level back in September and again in early October, that's your ultimate level of support. And as painful as it might be to get there, in my opinion, that's the best possible outcome if you're bullish for the back half of 2021.
Yeah, so January 5th, 6th, those are the next two big dates here. The Georgia runoffs, if the Democrats were to take both of those seats, then they would have control of the Senate. And the thinking there was that, if the Senate was controlled by the Democrats, the White House controlled by the Democrats, then Joe Biden's administration would be able to enact, a whole heck of a lot more, kind of fiscal stimulus, infrastructure spending, that sort of thing. It's kind of interesting, but that also comes with potential higher regulation, higher taxes, that sort of thing. I don't think if that were the case that we would see higher taxes anytime soon, maybe on corporations, not exactly on the people. And I think the way the market has acted this week to the $900 billion relief bill, the COVID relief bill, I think market participants would welcome, the Democratic control of the Senate here, whereas it used to be thought that maybe they wouldn't. So, the way I see that is that probably it's a net positive. It's probably a buy on a dip if that were to kind of sell off in that instance, if the market wasn't pricing that. And the other point I would just say, you mentioned the January 6th rally that Trump is going to hold in DC. This is just a prediction. I expect it to be a whole lot of nothing. Maybe he doesn't even show up because the numbers are not particularly significant. It would be an utter embarrassment. And so really, what is the black swan in January? What is the thing that markets are not pricing? Maybe the potential that he doesn't leave the White House. And we won't know that until January 20th. So I know there's a lot of smart people out there who are saying, just you wait. This is the reality TV president, and he's not done yet. The final episode may be a huge, huge cliffhanger. Who knows? The market's definitely not pricing that. But those are the events I think, in the next couple of weeks as you've laid them out. Let's just go to the NASDAQ here, the NDX, the NASDAQ 100. Guy, really important. We spent a lot of time on the macro setup talking about this, and maybe some of our viewers who are more into trading, macro sort of products don't love the micro. But when you look at the NDX, the NASDAQ 100, you look at the top 5 or 6 holdings, it's Microsoft, it's Apple, it's Google, it's Amazon, it's Facebook, and it's Tesla. That would be 6. They make up 50% of the weight of that index, right? And so when you think about the way that those 6 stocks go is the way that the broad market is going to go here. What is your take on the way that those stocks have performed? And what do you think the potential maybe for investors who've held on to these names that have massive gains, who don't want to pay taxes on them this year? What do you think happens in the new year? Is there the potential for profit taking in these big names, which could find its way across all the major indices?
Yeah, that's a great point to bring up in terms of profit taking in those five names specifically, and what is going to be the effect. I mean, the bulls will say that'd be a great thing because that money's going to find its way into these cyclical names, and it's just going to be, one off, one on. So although the Nasdaq might feel a little bit of pain, maybe you make up for it on the back of the S&P 500 or some of these Dow stocks. That obviously remains to be seen. I don't want to get too granular here, but you have to in terms of the Nasdaq, and just a couple different things in terms of individual stocks. Dan's been all over Apple for quite some time. And today, again, Tuesday, December 29th, if you look, Apple traded right back up to that prior all-time high, which I believe we made on September 2nd of 137.98 and reversed. I had to read Moby Dick when it came out in its first edition in college, Dan. I know you probably got it years and years later. I bring that up because Melville's book was like 800 pages long, and I didn't read the entire thing. I sort of, put little footnotes on different pages. And I think today could be one of those days that you footnote. And why do I say that? Because as we sit here, the market's reversing a bit to the downside. The VIX is probably about to turn positive. Apple went from a new all-time high to negative on the day. Just a lot of weird things happening, albeit on probably because what's going to be a pretty low volume day. But bookmark this day because I think we're going to come back and look at it. Look, in terms of Amazon had a huge move from 3,500 to 2,950, pretty much in a straight line. It's gotten back some of those losses, and it probably sets up well into earnings. The one that really I think is the most interesting out of all of them is Google in terms of valuation, but the outlier to me continues to be Facebook, because I do think in 2021, Facebook's going to fall under the auspices of ESG investing, and I think you're going to be surprised by how many people flee the name. And that's has nothing to do with earnings or how important a company it is. I think it has everything to do with people getting socially aware and saying, what, maybe Facebook is the culprit in all this. So to answer your question specifically, I think you could see a big move to the downside early 2021, and it's going to take us maybe to that level of support that you outlined, which comes in around 10,600 or so in the NASDAQ.
Yeah, call me Ishmael there, pal. This is a pretty wide gap between where the index is trading and where its 200-day moving average is, which has been creeping up, which I think is really interesting. To your point, it comes right at those September lows, the 200-day moving average, right around 10,600, about 22% below where the index is trading right now. That's a pretty wide gap. And when you think of the performance of those white whales, if you will, of Apple, which is up 85% on the year, it's the second year in a row the stock has gained 85%. That's truly astounding. A $2.3 trillion market cap. I guess the point is that if those stocks all started going in the same direction at the same time, lower, you would have a meaningful correction. And listen, here's the other thing. The supply, we've seen some massive IPOs, the Airbnb, the DoorDash, the Snowflake, Palantir. These are massive market cap companies that don't have a whole heck of a lot of earnings, trading at ridiculous multiples of sales. At some point, the chickens are going to come home to roost a little bit, where investors really start to think about how much of the performance have they pulled forward in such a short period of time. And the other point is there's like 225 SPACs out there that raise money on the public markets that are looking to take companies public from the private markets here. A lot of those are money losing companies. So to me, this was the year where a lot of unprofitable companies came into the market at a time where exuberance is pretty high. The NASDAQ, listen, that's been in a multi-month consolidation. It just broke out. That's a pretty bullish sort of thing. I think a healthy pullback below 12,000 in the new year might be setting the stage for further consolidation and then a later year breakout here. Let's go to the Russell 2000, the small cap index guy, because this is the one that spent the most time below its 2020 high in this kind of recovery here, but since early November has rocketed about 30%. What's your take on small caps, and what are they telling you about rotation and about an economic recovery in 2021?
Well, I think what they're telling about an economic recovery is the market is extraordinarily optimistic in terms of what it means for some of these small cap names, on top of which you obviously have the fiscal side of things with this new fiscal bill seemingly being passed. I can't really keep track, but another $2,000 check coming people's way. Obviously, that's on the back of the one we saw 6 or 7 months ago. Time sort of escapes me, but I think that's playing into this as well. And oh, by the way, I think there's a hope that under this administration, this new administration, there's going to be a lot more money put in terms of the fiscal side of the equation. And I think that's what you've seen in terms of the IWM, the Russell. And oh, by the way, the fact that, again, the Fed seemingly has everybody's back. And oh, by the way, just one more thing, the fact that Jerome Powell, the last time he spoke, talked about valuations really not mattering. And that's not me. It's me paraphrasing to a point, but he pretty much said that in an environment with low interest rates like this, valuations, PEs don't matter, which I find just to be an abhorrent comment to make. But, you know, it is what it is. You finally had a Russell which underperformed seemingly for 18 months, now outperforming, but quite, you know, interesting over the last couple of days. You know, you've seen a bit of a pullback, you know, sort of signs that maybe this thing has gotten way too far ahead of itself. So that's something to watch as well. Listen, again, you know, you can, if you're just looking at this and I look at it, you can draw a trend line from the March low, probably connect it to that September low, and you'll see where the ultimate level of support is. And by the way, it probably comes in the form of that prior all-time high in January and mid-February. So, you know, again, I think the Russell is way ahead of itself here. And I think a lot of people feel the same way. But quite frankly, I would have said that 15% ago, Dan.
Yeah, which brings us to the VIX here, and this is one that you've been tracking pretty closely here. We're kind of just above 20 here, and if you look at the 2-year chart that we have, that 20 to mid 20s for 2019 was massive resistance. What did it mean when the VIX got to the mid 20s in 2019? You know, it was pretty much the all clear to buy stocks, if you will. That was a year the S&P 500 closed up close to 30%. If you look at this year, you know, we were kind of at the lows back in January. The stock market was making new highs every day, right up until that February 20 high, and then the market collapsed 35%. You see what the VIX did. It had that move, you know, all the way up to what, close to I don't know, mid 80s or so. And where have we seen great buying opportunities in the market in 2020 when the VIX is kind of topped out above 40? That's pretty remarkable when you think about year over year, the different levels of volatility. Well, here we are at 21-ish or something like that. Are you expecting, if we continue to melt up, if we get through these runoffs and we don't have any major market palpitations, is the VIX going to be a teenager again, Guy?
Well, I mean, that's what a lot of people indicate, the fact, again, that the Fed's seemingly backstopping everything and they dampen volatility. And there are a lot of people that think we go right back to that 14.5 level that we saw basically in December of last year, right before things hit the fan, and as we were making new all-time highs in the stock market. I'm not one of those people. Just go back to last Monday, by the way, prior to last Tuesday's macro setup, when the VIX spiked over 30. It went from 21 to 30 in a straight line on a broader market that pretty much did nothing. I mean, at its worst during the trading day, the Dow was probably down 400 points. In the pre-market, it was probably down 650, 700 Dow points. But I bring that up because you saw the VIX basically go from 21 to 30 in a very short period of time on really non-important news. What does that tell me? It tells me the VIX is a, you know, I used that coiled spring before. I'll use it in terms of the VIX. And I think that's exactly what it is. Dan drew the line. I mean, the levels that we saw earlier today and yesterday are levels of support. We've bounced off this a number of times this year. I think we're going to do it again. And the fact that the VIX exploded as quickly as it did in as short a period of time as it did on pretty much a lack of news that was out there concerns me. And it should concern everybody. You see how quickly the VIX can go from 20 to 30. And quite frankly, you see how fast it goes from 30 to 40. So I do think volatility is a story in early 2021 for a number of the reasons we spoke about earlier, Dan.
Yeah, and just looking out to January 22nd expiration, that's the regular expiration. If you were to take the SPY at the money straddle, that is the call, and that is the put. You put those two premiums together with the VIX, with the SPY around 372, that would cost you close to $13. Do the math, Guy. What's 13 divided by 372 on a percentage basis? That is the implied movement between here and January expiration, and that's about 3.5%. So if you were looking to say, I want to be long the SPY or have the right to own it at 372 and you know, between now and the next few weeks, it would really cost you half of that 3.5% straddle, right? So it's about 1.7%, 5%. That seems really cheap. So it costs you about $6.50 to own the at the money call or the at the money put between now and January 22nd expiration. And so when we talk about the VIX, we're really talking about the volatility of the underlying index, right? And so that's what takes me to look at SPY options or SPX options, whatever you're into. That is pricing to me, I think, very cheap movement between now and over the next 3.5 weeks or so. So for whatever that's worth. All right, guy, let's move along here. The 10-year U.S. Treasury, this is one, you just mentioned what Powell had to say about equity valuations relative to yields. What is the 10-year U.S. Treasury telling you? It's been on this nice kind of up trend since early August. We've gone from 50 basis points to just below 1%. Why hasn't the yield moved higher quicker? It's just kind of been this slow grind higher, where I know a lot of investors are expecting higher rates going forward, despite what the Fed is telling us.
Yeah, I think it's interesting. You're right in so much as it's just been this grind, like tick by tick grind higher, painful to watch. But I think a lot of it is predicated on the fact that, again, you have central banks in there buying these assets that are probably artificially keeping rates down. But for them, I think a 10-year yield would be significantly higher. But again, it doesn't matter. That's sort of the state of the market. I say it all the time: trade the market you have, not the one that you want. And this is what we have right now. But with all that said, you have a very well-defined uptrend again since those early August lows, and I think that uptrend continues. I think there will come a day when you see that significant spike to the upside, not unlike what we saw back in March and again back in early June. And I think we're setting up for one now. Everybody seems to be convinced that higher rates are somehow bullish for the stock market because they suggest economic growth. And I can understand that argument. Obviously, it's pretty logical. I'm not one of those people, though. I think it's going up for the wrong reasons. I think there's inflation that's out there that's not being measured. And I think rates are probably getting away a bit here. Now, the Fed will say they want rates higher, and a lot of people will say that as well. But they want it higher in a methodical way, and I don't think they're going to get that in early 2021. One of my big concerns for 2021 is not rates going down in a precipitous way, is that rates exploding to the upside on the back of perceived growth that's not going to be there. And that's a bit of a witch's brew, is the term that I use all the time. And I think that's, again, what we're setting up for. So I know this is not a product that the Nadex folks trade, but my line in the sand, if you can pull it up, comes in the form of the TLT around 154. A close below 154 in the TLT, to me, really suggestive of rates that are going to explode to the upside, Dan.
Yeah, well, we can't pull it up, so you guys are going to have to go to your Google machines and check that thing out. But we do have a 10-year price chart of the 10-year U.S. Treasury yield. We were just looking at that 1 year. And when you look at that, when you say that you think the potential for rates to explode higher, I mean, to me, what I think is really interesting is that 1.5 level in the yield is massive technical resistance, going back to 2012, going back to 2016, going back to 2019, and then obviously the break early this year. I mean, for the yield to get above that, there's got to be a lot of good things going on as far as our economy is concerned, and really the state of global interest rates. And so to me, I think 1.5 will be a level that, if we get above there for the wrong reasons, to your point, I think alarm bells are going to go off in a lot of different risk assets. I think it's important to remember, when this kind of downtrend started in late 2018, the 10-year U.S. Treasury yield had spent the last year or a year and a half or so going up from 1.5 to 3.25. It doubled. Equities did go up. There was people saying it's different this time, right? Because equities and yields can go up. But what happened in late 2018? The stock market went down 20% in a straight line, didn't stop going down until Fed Chair Powell really changed their tune on their Fed, on their policy. All right, here's a topic that's a great segue to the U.S. dollar. You've been all over this massive decline in the U.S. dollar from the March lows or March highs. We are literally teetering with multi-year lows here at the Dixie around 90 or so. Give us your take here. You know where I've been. I've been cautious about pressing it here for new shorts to come in. This is one that I have agreed with the short, but I think it's a dangerous press at 90 here. What's your take? We have a 1-year chart of the U.S. dollar index, the Dixie.
No, and I think you've been right to be cautious, because clearly everybody now the consensus seems to be that the dollar's headed significantly lower. And typically that's a warning sign. So I completely understand your apprehension to press, and it makes total sense. And by the way, if you're disciplined, now's not the time to be pressing. What I'll say is sometimes the herd can be right. And I think the fundamentals are in place. And again, we talked about Moby Dick earlier, that long book. We have to sort of bookmark different pages. We'll go back to last Monday if you want another bookmark for the move in the dollar. You saw a huge flight to quality in the US dollar earlier that day. The dollar pretty much ratcheted higher on the back of an equity market that was being sold off. That rally in the dollar lasted for about 3.5, 4 hours. And if memory serves, that day we closed basically unchanged in the dollar. That told me all I needed to know. If the dollar couldn't rally that day in a meaningful way, given the amount of people that are on the same side of the trade, given the sell-off that we've seen, when is it going to rally? And here we are now. You have the Dixie up, below 90. And again, I think we're headed to levels that you'll see in the next chart that's suggestive of, a further move till we see the ultimate level of support. But that downtrend that Dan drew is intact. The fundamentals are in place for the dollar to go lower. The January runoff, in my opinion, is not taken into consideration. I think if the Democrats were to win, you'd see another leg lower in the U.S. dollar, not because they're bearish for the dollar, probably quite frankly the opposite. I think because you'll see more fiscal stimulus. That stimulus comes out of thin air, and that's obviously dollar negative. So for me, the consensus trade, it wasn't for a while, but the now consensus trade of a lower dollar is in place and makes sense. And I think it plays out early in 2021.
Okay. Yeah. I mean, I guess my take, very simple, is I agree with all of that. I am apprehensive to press here. I think you used little pops to kind of short it. And really what you're eyeing is that 88 level in the Dixie, which is not too far away, but I suspect you probably look to cover there. Let's go to gold. This is obviously kind of a trade that a lot of people kind of connect to the dollar here. You had this move here, a really explosive move earlier in the year and into the summer, where I think some might call what we saw, that price action, as a bit of a blow off. But we've seen this decline here, from above 2000, we're just below 1900. What's your take? We have a 1-year chart here of XAU, of gold, Guy. I know you want to be bullish of gold here. It doesn't act that well, and we're going to get to Bitcoin later, but it just seems that Bitcoin has stolen a lot of thunder from the gold bugs.
Yeah, it doesn't seem that way. I mean, it actually is that way, and I don't think that makes sense. I understand what people are saying, that there's a choice, there's a binary choice. It's either Bitcoin or gold, and I think obviously what's happened over the last couple of months, people have chosen Bitcoin over gold. But I think each one of them has a different utility. I think the market's looking past that right now. I think at a certain point, people are going to figure out that these are independent of one another, and they can go up in parallel. So I happen to think we're going to see that August 7th high of about $2,080 or so. But it obviously requires to break through this downtrend line that Dan has drawn so well, which I think we're on the precipice of doing. I think the dollar continues to go lower. I think rates continue to probably do that grind higher. And Dan made a comment earlier that 1.5% in the 10-year is suggestive of things going really well. I take the other side of that. I think if we get to 1.5 in the 10-year, it's suggestive of things going really pear-shaped in a meaningful way. But that's a conversation for another time. To answer this question, I think the first stop is the early November high, and I think we're ultimately going to see the August 7th high again early in 2021. Gold is still a story; it hasn't gone anywhere. I think the Bitcoin move flushed a lot of people out. I think the move to the upside in equities flushed a lot of people out. I think that will be short-lived, and I think we're going to break through this downtrend line. So if you're looking for ways to play it, you see the line, you see the levels close above this downtrend line. I think it's suggestive of the early November high first, and then the ultimate goal being the August 7th high.
Yeah, we have a 10-year chart. I think it's pretty interesting when you see that gold topped out back in 2011, and then you see that precipitous decline. I mean, it was trading really near where it is right now, and it made its way all the way down to its lows in 2015, near 1100 here. So I would say that, contending with that prior all-time high is a big level, and maybe that's what it will also take. It breaks that near-term downtrend, but then also breaks above that long-term resistance was that prior high. All right, like pretty interesting. We're talking about, the Trump administration winding down and a transfer. It hasn't been the easiest of transfer of power here in the U.S. probably in centuries, to be very honest with you. But it's interesting to look overseas. And before Trump was even elected, we had that it was a political earthquake, which was the Brexit vote in June of 2016, and that was a huge bout of volatility in risk assets all over the planet. It feels like we've been under siege, or at least in the currency markets, about the Brexit and the timing. It just seems like there's been one missed deadline after another. And Boris Johnson, the PM over in Great Britain, finally got a trade deal done. This was something that had a lot of investors, traders on the edge of their seats here. We were talking about this in the lead up. Is it related to the British pound here? Were we going to get over that significant kind of technical resistance on a 1 year and also a multi-year basis above 135? We're still straddling that guy. Do you think that this deal sets up for a breakout for the pound, a sustained breakout where 135, which was resistance, becomes support?
Yeah, and this is obviously the shorter chart. And if we go to the longer term chart, which is so I think we have a 5.
Yeah.
This will show you where we're ultimately headed. And I think it comes in the form of the highs we made in mid 2018, which probably takes us pretty close to 145. So to answer your question, again, very similar in terms of the levels being outlined for you with Dan's trend line. You see where we break out from. We're on the precipice of doing that. And I think, again, are there straight lines to the upside, downside? No, not necessarily. But you have seen moves of significant, meaningful velocity and width over the last couple of years. And I think, again, you saw it early 2020. You saw it in mid 2016. And I think we're on the precipice of seeing it again. So here we are at this 135.5 level, give or take. And I think the next stop is the early 2018 high, which is 144.5, 145. And I think we can do that relatively quickly, again, in early 2021. I think a lot of things are going to happen faster than people realize in 2021. We've outlined a few of them. I think the British pound is clearly one of them.
Yeah, so obviously that trade deal was a positive for the euro too. When we think about those crosses versus the dollar, if you look at the U.S. dollar index, I think 50% of that is euro and pound here. So you have the euro holding this very steep uptrend from below. I don't know, it was probably 107 or so, all the way here at 122.5. And if you look at the 5-year highs in early 2018, that gets you back up towards 125.5 or so. That seems to be where it's headed. We see that uptrend, which has been good support. That would bring you back to 120, which could be a good level to kind of reload if you're bullish on it. It's also the breakout level of that consolidation that we've seen over the last few months. And to Guy's point, he said this a number of times on the program today already, things just don't always go in a straight line. That's why we draw a lot of lines here, kind of support and resistance, and it gives you levels to kind of reload or take profits or kind of reshort here. So that seems to be the euro. Let's finish off 2020, our last macro setup guide, with just a quick conversation on Bitcoin. You and I have had the benefit, and I think we brought Brian Kelly, our very good friend, who runs a digital asset management company, BKCM, and he's our obviously fellow panelist on CNBC's Fast Money. He wrote a book on Bitcoin in 2014. I went to the book launch party. I think Bitcoin was trading in the low hundreds or something like that, 200-300 or something like that. He's been all over it. He's been a great gauge for us as it relates to looking at this asset or risk asset and kind of getting a sense for sentiment. To me, I don't really have any interesting takes on Bitcoin. I don't think you do either, one way or another, but it's really interesting to see, let's go to this chart here, man. Oof. I mean, this rally that we've seen since that breakout, in early fall, 10,000 to, I think it got as high as 28,000 the other day. It's pretty remarkable. What is that saying to you? And here's the thing. I think this is the sort of risk asset that people who have a lot of money like to invest in. Do you know what I mean? It's not like democratizing the, you know what I mean, like the investment landscape for the people or anything like that. I think this is the sort of thing where asset managers who have the money, and maybe it's not their money to kind of deploy here, or very high net worth individuals or people who are looking to push cash somewhere. I'm not sure it speaks to anything particularly bullish for the economy or for risk assets outside of digital assets. What's your take on that and the just explosion in sentiment in this sort of category this year?
Well, and its acceptance as well. And then just breaking down the chart, I mean, 20,000-ish was that prior high from 2017. If you remember, we traded up there in December of 2017, and obviously we went from that to 3,500, not in a straight line, but over the course of probably a year and a half, 2 years, and now here we are. We talked about it on our show. We actually talked about it on the macro setup. If you're just looking at this in terms of any other chart, you know, close above 20,000 is a breakout. And think about it. We moved almost 35% from that 20,000 level to what Dan just outlined. BK, Brian Kelly, is a bit cautious here, not because he doesn't believe in the story. He just thinks some of the sentiment is overly done at these levels. But the fact that it's been accepted in so many different places by so many different people that had prior been skeptics is suggestive of something that's being brought into the mainstream. What I will say is when you see things like, I think the name of the company is Microsystems or something like that. MicroStrategy, thank you. But they did a secondary offering. Think about this. And the reason for their secondary offering was to buy Bitcoin. Now, it's working out for them great right here, but just think about the absurdity of that. In my opinion, the absurdity of that. So maybe things have gotten a little bit overdone. What was resistance becomes support. That comes in the form of, again, 20,000. And I do think we're going to see that at some point relatively quickly. Doesn't mean it's over. It doesn't mean that the story is done. I just think it means that, you know, you do these back and fills in commodities, you do these back and fills in equities, and I think you're going to see it in Bitcoin as well, Dan.
Yeah, we have a 5-year chart really quickly, which highlights, Guy, that prior high in 2017. And I think what's really important to remember is that you and I, you know, on Fast Money, we were covering this story almost every day, and it was just a frenzy. And then it felt like just a battleground for 2018, 2019. And people were actually, and I was one of them, in early 2020, when the markets, when every risk asset was crashing, I was like, what happened to the uncorrelated nature, the store of value that was supposed to be Bitcoin? Because we saw Bitcoin trade under 5,000. It went from 10,000 under 5,000. There was a much greater percentage decline than, let's say, the stock market. It wasn't doing you any favors here. And so all of that has kind of come to pass, I think, when the central banks globally started printing money in a meaningful way, when it became very clear that it was really going to be easy monetary and fiscal policy that was going to get us out of this thing and avoid a depression. And that's when you've seen this thing just explode. I'm kind of with you. Listen, I will never understand it. And anybody who really understands this risk asset, listening to us talk about this, will probably just tell us how dumb we are. But sentiment is sentiment. And when it comes to kind of fear and greed, and right now, I think you are at a extremely exuberant period where if you are a naysayer, you are an idiot. And that just doesn't work out in financial markets. It can't work out for too long. So I'm with you in a way. I think a pullback to 2,000 or 20,000 if you're looking for an entry level here. So we're ending the year on the macro setup on Bitcoin. So that tells you all you need to know about 2020. I'll just say this before kicking it back to you, Guy. It's been my pleasure doing this with you over the last 3 months. It's been my pleasure doing this for the Nadex audience. We've gotten a lot of great feedback, and we really enjoyed doing it. So I wish all the viewers and your families a very healthy and happy new year. And of course, to you, Guy, and your family. So I will see you, I guess, tonight on Fast Money. You and I never get a break from each other,
which is unfortunate, although I've enjoyed it. And we, you know, what people don't realize is we'll probably talk 5 or 6 times during the day as well, in addition to the different things we're doing. So it has been a fun 3 months. We will be back in January. I think the next time we're back is Tuesday the 5th, I think. I get confused, you know, with the changeover in months, 30 days, 31 days. As Dan mentioned, I'm not that bright, and people on Twitter point that all the time. I also want to thank, obviously, Nadex. We thanked IG last week, but they're worth thanking again for being our presenting sponsors. I also want to thank the great people at Open Exchange. Brendan and Mike specifically have done a great job helping us navigate through all the production elements of this. We will see you next year. Hopefully you guys and gals have enjoyed it. I know we have. So happy New Year. And again, thank you, our presenting sponsor, Nadex, the premier U.S. exchange for binary options, call spreads. And Dan, give me the last one.
Knockouts, pal.
You're the man. Talk to you soon.